Seamless Research webinar, where we have the pleasure of hosting Jeffrey Frankel, who is the James W. Harpel Professor of Capital Formation and Growth at Harvard University's Kennedy School of Government. He directs the program in International Finance and Macroeconomics at the National Bureau of Economic Research, where he is also part of the Business Cycle Dating Committee, which is in charge of officially declaring recessions. He served at the Council of Economic Advisors in two spells, one from in 83-84 and the second one in 1996-99. And as CEA member appointed by President Clinton, Frankel's responsibility included and he currently serves as a foreign member of the Monetary Policy Committee of the Bank of Mauritius and on advisory panels for the Federal Reserve Bank of New York, the Peterson Institute for International Economics, and the Bureau of Commodities, Regional Blocks, and Global Environmental Issues. He was born in San Francisco, graduated from Swarthmore College, and received his economics PhD from MIT. So without further ado, let me welcome Jeffrey Frankel, who will be talking about monetary policy in emerging markets.
Thank you. Policy. For a chapter. And my I'm going to mostly hundreds of references. Highlights and try to because I'm also going to talk about and was asked to talk about which is an alternative kind of popular choices of the CPI or exchange rate targeting, or in the before that. On the screen is nominal GDP. A number of ideas I have changes. Institution robust changes in the terms of trade. Go to the next. There's a survey I found when I did this that there subject, at least not ones that were tried comprehensive. As mine did. It's a big field. At the NBER, every group, but just doing that now. It has been relevant to so it's certainly a very, very large why it's sort of when it did. Point is that be literature before the phrase emerging markets became popular. There was a feeling with industrialized countries, and we know it's not too surprising which were very prominent, highly market oriented, and open to international capital. In 1980s. Rather, developing countries tended to suffer and capital control. the world has changed a lot since then. Markets became possible. In many ways, the distinction between countries, all these distinctions have broken down. Countries today. Advanced countries, and never differences. I'm emerging market important lessons the risk of default and credit risk and financial fragility is not just limited to emerging markets. And there's all kinds of models of market imperfections that now, ever since 2008, we see we need to apply to advanced countries. But despite all the similarities, let me give you the outline of what I hope to cover today, and start with how emerging market economies still differ from advanced countries. And before I launch into this outline, let me mention that I feel you should all feel free to use particular important and you should also feel free one or two places along the way, and out loud. So the topics that I want to countries, and we still need to build those differences. My survey were inflation, exchange rate literature, and I'm just relatively comprehensive. From each of them. Discuss to the extent that there is time. Also, a lot has continued to happen in the literature and in the world since I wrote this survey, and I'll try to update it places where we go along, including one of the pretty topical questions. If the Fed were to raise interest rates, which emerging market countries are more vulnerable? What makes a country more vulnerable to a financial shock of that sort? I think we've continued to learn more about that in light of recent experience, such as the taper tantrum 2 years ago. And then I suppose if I were writing the survey today, there should be a whole section on macroprudential issues and policies, because that's become a big area of research. Thread, I want to discuss monetary policy. The CPI, and a particular concern of mine in recent years has been terms of trade volatility, which has been very large for countries in Latin America and for emerging market countries around the world. And to my mind, the traditional choices for nominal anchor, whether it's the exchange rate or the CPI, are not best designed if you're a country that has terms of trade volatility. So that's where I want to talk about some of the alternatives, ways of designing a nominal anchor for monetary policy that is more robust with respect to terms of trade changes. And one of those is nominal GDP targeting, I would argue. All right, well, first, given that there has been some convergence, emerging market countries becoming more like advanced countries, and I would say also vice versa, differences. Characteristics that distinguish well, I would I know there's a low presumption Um,
There is a
developed
then you proceed.
now.
Negative.
If you just say you're going to have low inflation. I would say that those remain and
Do you want to? I can open your microphone. And
throughout. And as I've said.
There is a
Earned credit ratings. That superior to some of the advanced countries, and they through uh, uh, since century in many responsibilities mainly focusing on and succeeded in bringing down debt to GDP levels. Substantially the levels of countries. But there is that's a praise from paper of carbon right hardened. And robot um, that for equal fundamentals equal levels of debt that countries trouble past history um, have lower level. I looked at it. Tolerance. In other words, their creditors are more worried. There's less more worry about default risk, lower credibility. So that's a set of differences. Another is pro-cyclicality. Uh, business cycle. I mean, in theory, government is supposed to use Keynesian theory. Supposed to be able to use its tool fiscal policy. But one might also mention monetary and policy. Financial institution regulations in a counter-cyclical way. So in a boom, you restrain the rate of growth to prevent overheating and bubbles, and in a crash, you were able to moderate the downturn. Well, we'll talk some about the evidence and the history that fiscal policy has been pro-cyclical in most developing countries, especially in Latin America, especially commodity producers, and especially Latin American countries. In the past, I will argue that this actually changed after the turn of the century. And then, if you're not a fan of Keynesian or activist discretionary fiscal policy in the first place, you might think that the private markets are the ones that will help stabilize when there's business cyclical fluctuations due to fundamentals like commodities or whatever. In theory, international financial flows are supposed to be counter-cyclical, but in practice, there's a lot of evidence that they have actually not been counter-cyclical. Often they've even been pro-cyclical. So I'm going to elaborate on those things. And then the final category is greater exposure to supply shocks and trade shocks. And I want to talk about that. So let me start off talking about that. Terms of trade volatility, of course, has been quite high. It's been higher in the last 10 years than it was in the preceding 20 years or so. And emerging market countries and developing economies tend to be more exposed to terms of trade shocks. In part, that's because they tend to have higher ratios of trade to GDP. They tend to be smaller and more dependent on trade. But of course, it's also largely because they tend to produce products, and this is true of much of Latin America, commodities, oil, minerals, agricultural commodities that have volatile prices on world markets. So I'm especially talking about volatility of the price of the commodities you export, but also on the import side. An oil importing country is vulnerable to terms of trade shocks, and commodities have a much higher share of consumption in emerging market and developing countries than they do in advanced countries. So it's not just on the production side where you get the terms of trade volatility. I would argue that emerging market and developing countries also tend to be more exposed to supply shocks. Dramatic example are natural disasters, windstorms, and so on. And the logo I'm going to use there is a volcano. They're not very common, but they're more photogenic than hurricanes or earthquakes. The natural disasters are not just photogenic and tragic, but they're also tend to be exogenous, and so they're kind of useful in some of the econometric studies as instrumental variables. Other weather events, social unrest such as strikes, all of these are more prevalent in, I would argue, in emerging market countries. And productivity shocks. There's much more uncertainty as to what the long-run rate of productivity growth is. If you have a boom period, some countries think, we're the next tiger economy, and then it turns out no, it was a bubble or whatever, and the fluctuations are just much larger there than in advanced countries. Here's just a recent study by the IMF. I'm showing you a simple statistic here. Developing countries tend to have more trade shocks. The terms of trade shocks are the blue bars, especially low-income countries, but also emerging market countries, and also more natural disasters. One kind of supply shock. Of course, terms of trade volatility has been very obvious in recent years. The big run-up in commodity prices up to 2008, again up to 2010 or 11, and the big fall, especially oil prices, over the last year. Here I've got a table from another paper of mine that I originally did for the World Bank and published in Economia. Here, just starting with statistics for Latin American countries, what the World Bank says is their leading export commodity, and what the standard deviation of that price has been over a 40-year period. Natural gas is the highest, and that's Bolivia and Trinidad and Tobago are their major exports. But petroleum is the second highest, and the others are high too: copper, coffee, bananas. So that's a theme that I'm going to come back to later on. The second topic in my survey was devaluations, nominal effects, real effects. Here I'm just going to focus on the costs of devaluation. I've updated an old statistic on the political costs. People sort of love to cite this, that there is a tendency after a devaluation for officials to lose their jobs. If you look at the 6 months following a devaluation, leaders are twice as likely to lose their jobs as if there were not a devaluation, and that's statistically significant. And it's even stronger for central bank governors and finance ministers. They're 63% more likely within a year. I say even stronger because the significance level is stronger, and that's over a whole year. Why has devaluation traditionally been costly? There's various possible explanations. There seems to be an extra effect. If you say you're not going to devalue and then do it, people then hold that against you. But mainly, I would say that often it's perceived as having a negative effect on the economy, and often that's true, at least in the first few years. Devaluation is sometimes contractionary. Our most standard models, of course, devaluation makes you more competitive. Supply of traded goods goes up. The demand for your exports goes up. Your demand for imports falls. Trade balance improves. It's supposed to be expansionary. But there's a variety of effects that can go the other way, whereby a devaluation can be contractionary. And the one that has received the most attention ever since the emerging market crises, the currency crashes of the late 90s, is the balance sheet effect. That if you have a currency mismatch where you borrow in dollars or some other foreign currency, but your revenues are in local currency, pesos, let's say, in a difficult situation, a bank or a company that produces something might still be a viable concern, except if you've just devalued by 50%, then your debt service requirements, of course, have doubled in terms of pesos, and then you may have to cut back your operations or default or whatever. I've listed here just some of the papers, especially on the theory side. This is probably where there was the most research after the currency crises of the late 90s, and there's been more since. But the general gist is that if you have this currency mismatch and then you devalue, you have this adverse balance sheet effect, which can be contractionary. And just as an illustration, here's a graph from a paper by Cavallo, Kissela, Perry, and Rubini. The horizontal axis is foreign-denominated debt times the magnitude of the real devaluation. So that's a measure of the adverse balance sheet effect. And the vertical axis is the change in output. And there's a fairly strong relationship there. There's an example. South Africa in '96 did not have a contraction in output. And it's debt, it's one of the countries that even back then was able to borrow in its own currency in rand. The capital inflows were either direct investment or some of them were in rand. And it was much less dependent on borrowing in foreign currencies and did not suffer a severe recession at that time. At the other end, we have Indonesia, which is the country that had the biggest adverse balance sheet effect when it devalued in '97. It had a big devaluation, and a lot of its debt was denominated in yen and dollars. And sure enough, it had the most severe of the recessions, the biggest loss in output of the currency crisis countries in the late '90s. So that's just one graph that kind of captures the principle, which by now I think is pretty familiar. And in many of these studies, I'm just showing you one simple graph, but the econometrics, of course, is more thorough, more careful, controlling for variables and worrying about endogeneity in most cases and so on. So, I mean, a natural question then, yes? Please. Sure, I don't see anything on the chat history. Well, let's see. So if it's the price of oil, obviously it's opposite effects on the oil importers and oil exporters. But could you state the question again? Yeah, yes, I would. I would. I mean, there's a matter of terminology, but this traditional distinction between demand shocks, including monetary policy, but also other demand shocks on the one side versus supply shocks on the other. I mean, terms of trade shocks can have attributes of both. If you're talking about you're an oil importer and the price of oil imports goes up, that can have contractionary effects both on supply and on demand. But I guess I'd mainly classify it as certainly a real shock, and I guess I would classify it as more on the supply side. I don't know if she was thinking of an increase in the import price or a fall in the export price, but in either case, it's a real shock. I'll be coming back to that. Is that okay for now? Feel free, please. Who's the author of the paper? Well, I was going to talk about fiscal issues later, but I wasn't going to spend too much time on it since we're mainly focusing on monetary policy. So let me give a preliminary answer now. I mean, what the graphs that I was going to show later show in the paper with Bulletin and Vague and Bulletin that you mentioned show is that while there was clearly on average a pretty strongly pro-cyclical position for fiscal policy in emerging market countries generally, especially commodity producers, especially Latin America, that for many of them that reversed after 2000. I would also say there's some backsliding lately for some of them, which is probably worrisome. But when you look at to answer the question, when you look at the components, and my co-authors have done that, looking at taxes versus spending, there are some interesting stories to tell. And I would say that a lot of the pro-cyclicality was on the spending side, that when there's a commodity boom, and the government feels it has lots of revenue and feels it will go on forever, which there is this pretty systematic tendency to misperceive, that spending then increases rapidly. And two areas that I would identify are infrastructure spending, which can be really useful, but can also be liable to corruption and so on. And in any case, it has kind of a long horizon, and it's pretty wasteful if you then have to reverse it. Or stop in midstream, or don't have the money to spend on the maintenance for the roads that you built. So one area is infrastructure, And the other is the government payroll, which of course is a huge area. And it's health and education, and in some fields it can be very useful. But there's a big increase in the government wage bill. And there is evidence that is especially hard to reverse, that it's downward sticky. Rezki and co-authors at the IMF come to mind, a co-author. And I've looked at just for some oil producers, that the government wage bill goes up when the price of oil goes up, and then if the price of oil goes back down for an oil producer, that's really hard to cut back on. So I think that is one of the sources of the difficulty. I'll show you those graphs later. Should I go on? I don't see, under the chat, it's supposed to say people who are writing in with questions, isn't it? I don't see any. Oh, maybe that's the case. Because do you see them there? All I see is how do I, let's see. Sorry, everybody, this is my first webinar. Yeah. So I don't see any on mine, and I don't yet see, let's see, start chat with attendees. How's that? That's a list of individuals. I don't see everyone, I'm sorry. Should I go on? Yes. Maturity mismatch or currency mismatch? I mean, I would. Well, I mean that. I mean, that's surprising, of course, both on logical grounds and there's so many studies suggesting the currency mismatch is important. Although I'm going to argue later that it's that many emerging market countries, maybe a majority, after the turn of the century, managed to overcome that problem. Let me go into let me go ahead because that's where we are right now. I mean, currency mismatch in the balance sheet is a big balance sheet problem. It's the one I'm just going to focus on. And maturity mismatch, of course, is another possible problem. You might ask, why do countries develop weak balance sheets in the first place? Why have this kind of vulnerability? And I'm identifying four explanations, which are, there could be some truth to all of them. First one is quite famous. Original sin is a phrase coined by my colleague Ricardo Hausmann, and that's the idea that the origin of the currency mismatch is debtors in the emerging market countries might like to borrow in their own currencies, but they can't, and they can't hedge either because the investors in the advanced countries, the creditor countries, don't want to undertake exposure, don't want to be exposed, don't want to go long in the currencies of emerging market countries. And the idea of original sin is that this was, there's nothing much that the policymakers can do about it today. They inherited this situation from long ago, presumably a past history of high rates of inflation and depreciation. So that's theory number one. Theory number two, I mean, the other co-author of the original sin paper was Eichengreen, but he had a slightly different view from Ricardo. Barry did. It's that adjustable currency pegs, which is what most emerging market countries, most Latin American countries had in the going into, before the Mexican peso crisis in '94, let's say. Adjustable currency pegs create a false sense of security that you actually want some very clearly. And especially to debtors. Risk. And then they'll be they will avoid dollar liabilities, or if they incur dollar liabilities, they'll hedge them using derivatives. And if they weren't doing this in the past, because they had this false sense of security. And so if you have more exchange rate volatility, that'll be clearer. And Andres Velasco, another former colleague of mine, wrote on this as well. Now, I have to say, 15 years ago, it seemed to me that the original sin claim was more plausible than the idea that if you just create some gratuitous volatility in exchange rates, that will cause the currency of denomination to shift. But I would say I was wrong. I mean, the experience since the turn of the century, when many major emerging market countries in Latin America and elsewhere increased the exchange rate flexibility, or even went to full floating, as Chile did for a while, and Mexico and Brazil to some extent. That the higher exchange rate volatility perhaps is the reason why so many emerging market countries over the last 10, 15 years have been able to borrow in their own currency. So to suggest that the original sin was not as deeply ingrained as it might have appeared 15 years ago. Sort of getting ahead. The third theory is moral hazard, and this is part of the third generation models of speculative attacks. I'm referencing here Michael Dooley, Paul Krugman, and Wei and Wu, among others. But by borrowing in dollars, well-connected local banks and local companies put the risk onto the central bank. That if the investment pays off, then they do well, and if it does badly, and if the economy does badly, they can lay off some of the risks to the central bank by cashing in their currency for dollars. And then the fourth one, procrastination of adjustment. That's something I used to talk about. That there is a pattern where a country may in fact be able to borrow in dollars. Mexico had its tesobonos, sorry, may be able to borrow in its own currency. Mexico had its CETES, was in fact able to borrow in pesos, many of which were held by foreign investors ahead of the 19. And there is a pattern certainly was true of Mexico in 1994, that when foreign investors start to lose enthusiasm and capital inflow turns to capital outflow, whether because the Fed has raised interest rates or I think risk off, switch from risk on, risk off, or whatever the reason is, local fundamentals. If there's a sort of a choice between trying to tough it through versus adjusting adjusting earlier, but rather than later. And one way of kind of postponing adjustment, if you think that things are going to turn around, if we can just get through the next election, or if we can just get past the period of instability, or the Fed increase in interest rates, or whatever. Way to postpone it. Switch. The maturity. And the currency. To keep foreign investors happy. Dollar demand. And I have that. So this is the capital turned around and turned flow at the beginning in 19. And that time, the next authorities switched the composition from the peso denominated borrowing, which were the setes to which were the so you can see here initial shocks, the Fed starting to raise interest rates and some stability and assassination of Luis Donaldo Colosio, presidential candidate, you can see the major shift in the currency composition. So that meant that, I mean, you can argue about whether, you know, it was worth a try or whether you should have seen this coming. But in any case, when in the end Mexico was forced to devalue at the end of the year, it was under circumstances where the currency mismatch had set in, and so it did have the adverse balance sheet effect. So that's the procrastination hypothesis. I think there's probably some truth to all of them, but has changed. 90s, is that when the capital started pouring back into emerging market countries, let's say around 2003, there's the peso crisis, right at the peak. When capital started coming back into emerging market countries after 2003, it was much less denominated in dollars and other foreign currencies than it had been in the past. Some of the capital inflows were direct investment or equities, but many emerging market countries were able to borrow in local currency, even countries that in the past had not been able to, in the way that Mexico and South Africa and a couple others had been able to. So this is a graph from a couple of recent Harvard PhDs showing for a sample of 14 countries the increase in the dollar to especially the government private debt. Was increased after 2003, and is the share it's in local currency rather than in dollars or other foreign currency. And so I would say that many of these countries have been able, since the turn of the century, to greatly reduce the currency mismatch problem. And that's important, particularly when we think about who might be vulnerable to future shocks in world financial markets. The red line there is the government. Now, some of these respects in which emerging markets reduce their vulnerability after the turn of the century, in some cases there's been, I would say, some backsliding in some countries, and in particular on the currency mismatch issue. Although the movement was all in the right direction initially, since 2008, there's been some swing back to dollar denomination in the case of some emerging market countries. So this is Peru. The first graph is how much local currency debt Peru has. And there was a big shift after 2003, an increase in local currency debt. And notice that foreign currency debt fell, at least government foreign currency debt, not just as a share of the total, but even just as a share of GDP. Quite clearly upwards. In the share of Peru's government debt. Denominated in dollars, in local currency rather than in dollars. So that's a good thing, less currency mismatch. In the case of the private debt, the corporate debt, initially there was that same movement between 2003 and 2006 or 2007. Just like with the public debt, there was a shift away from dollar denomination towards local currency. But now here comes this backsliding I was talking about. In the case of the corporate debt in Peru and some other countries, it's gone back the other way. I don't know whether it's a result of the global financial crisis in 2008. The timing is, suggestive there. But you can see that there's been quite a reversal. And so the private sector, the corporate sector, I would say, once again, has this currency mismatch and once again is vulnerable in some of these countries to the possibility of a new crisis. So topic 3 is inflation. Let me make another try at getting, because I can't see any of the questions. Oh, there's everyone. You know what? I just found it. I just found it. All right, let me look through these questions. I see the question from Oscar Carvalho about, and I see the reference about currency. I don't know that paper. I'll have to take a look at it. I see, Alberto, your most recent question. Anyway, if any of you have been holding off, now you can do it because now I can read them. Okay, thanks for that reference by Gonzalo Llosa. Take a look at that. I don't know if I can ever update my survey because now the literature is so big. It really probably is too big to survey. I will go. I'll go a little further, and then if I don't see some questions on new questions on the chat line, I may invite you all to make oral questions. The third topic in the survey is inflation, which, needless to say, was an overriding concern in the 70s and 80s. And so a lot of the literature that one would survey is from then. And I have projections on hyperinflation. I'm not going to go into that. In advanced countries, inflation peaked in the early 1980s.
Right,
the left
so
graph
you
shows
could enable to
the
write
median
for it
inflation
in case
for
you want
Latin America,
to
and the
stay
shaded
high,
blue
ask a
is the
question,
range of inflation rates.
whatever
And of course,
you would
in the
like to
80s, there
do.
were a fair number of countries that had inflation well over 100%. But it's come back down since then, both in Latin America and emerging markets overall, needless to say. I wouldn't say that the problem has gone away. It's been there all along in some countries, and this is a pretty recent statistics from the IMF World Economic Outlook. And
perhaps if there are
Venezuela,
no
big problem. Argentina,
there is one there.
Can you hear me? Problem, at least
yeah, Oscar, you
inflation
can.
is higher than desired, which is not a trivial statement, because in so many advanced countries,
Yes,
inflation lately has been lower than
can you hear me?
desired. Is this something to worry about? Well, I think maybe we should start worrying about it.
I was thinking about this question about
one of the areas of the literature that is useful to update over the last 5 years.
And at a theoretical level, did you think that the
market on QE by the end of the year, and U.S. interest rates, long-term interest rates, rose by about 100 basis points in reaction to those statements by Ben Bernanke in the spring of 2013. And there was this shift from, if you want to say, from risk on to risk off, that investors pulled out of assets that were perceived as riskier around the world, and that included emerging markets, and it particularly included some emerging markets more than others, the so-called Fragile Five, for example. And it shows up whether you look at how much their currencies depreciated, or stock market sovereign spread. At at least the statistical seems to be sensitive. Here we're talking about inflation. How high the inflation rates countries were at the time against how hard they were hit in terms of the depreciation of the currency during the remainder of the year. And the ones that were hit the hardest do tend to be ones that have higher inflation. There's Brazil, there's Turkey, there's South Africa, there's Indonesia, and there's India. And this is the, well, it's almost the fragile, it is the fragile five. Now later, if we have time, I'll look at some other measures like the current account, because there's also a pretty strong correlation there. But anyway, the suggestion is that after a period when it wasn't much of an issue, inflation may once again be an issue. That was, by the way, that was reaction in the foreign exchange market. If you look at the increase in sovereign spread, you find the same thing. So this is a recent IMF paper. And here, the horizontal axis is, again, the inflation level at the time of the taper tantrum 2 years ago. The vertical axis, once again, is a change in the exchange rate, but the size of the blue circle of the bubble is how much sovereign spreads went up, how much bond yields went up. And the ones with the big bubbles are Brazil, Russia, Turkey, South Africa, Indonesia. So again, pretty high correlation with the inflation rate. How were so many countries, which is pretty much everybody, how were so many countries able to bring inflation down after 1990? I think it's sort of an understudied question because it's so universal. There has to be some common explanations. It can't just be, smarter, better central banking in general, since it's so widespread. And I think it's a question that's still somewhat open, but probably the answer of most monetary economists would be that institutions to achieve credible commitment to price stability is the reason. And these were innovations, and academic research played a role. And classic model would be the dynamic inconsistency model of Barrow and Gordon, and so on. That under discretion, there's a bias towards inflation, and you need to tie your hands in a visible, credible way to prevent that. The literature suggests that this is more of an issue with developing countries and emerging market countries, where due to past history or for whatever reason, there's a greater need to address the problem of dynamic inconsistency because credibility is weaker. One big way to do it is central bank independence, and that certainly has been a big trend in the world. And in the survey, I go over 6 or 7 of the papers that look. And, well, actually, a couple of them are contrarian, but the 6 or 7 papers find countries' central banks' independence tended to better in some cases with
I'm not sure if there's any other question.
Sebastian, the other institution,
Sebastian, if you want to do it more
not competitive, but they're complementary, okay. I guess, would be the adoption of a rule. Pre-announced rule like the old monetarist rule of a fixed rate of money growth, or if not a rule, and of course it's very hard these days to deliver on a narrow target for money growth or inflation or just about anything else, especially including nominal GDP, which I'm going to talk about later. But I don't think we've lost the desire for transparency, for communication. I think we think that even if you can't, commit to a rigid rule, that central banks, most central bankers want to be.
It all depends. Yeah, I think it all depends on
by means
your availability.
Whether you call it forward guidance or something else, often it's by means of referring to some economic variables and making some degree of commitment to some intermediate target, even if it's not a rigid one.
That is fine.
But what are those targets?
The advantage also is that it keeps. We are recording it, so people can.
The 19th century was the gold
look
standard.
At it later.
In
this might be the only
early 80s, it was M1.
To hear these things from you, so please go ahead.
Supply. There was a move away from money targeting towards exchange rate targeting. I could even say back towards exchange rate targeting in the 1980s and early 1990s. And many Latin American countries that had high inflation rates or even hyperinflation and kept trying to stabilize but failed. Many of them, when they succeeded, most of them, when they succeeded, it was in part by using an exchange rate target or exchange rate anchor or even a fixed exchange rate as part of the process. And then after the crises of the 90s, there was a move from exchange rate targeting to floating and to inflation targeting. So let me spell that out a little bit. Stabilization programs of the late 80s and early 90s tended to use exchange rate targets. And the problem with money, of course, is velocity shifts. Even Milton Friedman, before he passed away, conceded that he had been wrong about the money demand function being stable. I think that's something pretty much everybody agrees on these days. And I don't have to. A lot of this is better known by the people listening than by me. But here's some of the stabilization plans, exchange rate based stabilization plans that were successful. So that's the move to from money targeting to exchange rate targeting. Then after the currency crises of the late 90s, and if you measure it broadly, that started with the Mexican peso crisis in '94 and went through Argentina and Uruguay 2002, and most of those countries decided, probably correctly, that exchange rate pegs were untenable and moved to greater exchange rate flexibility, or a few like Ecuador moved the opposite direction, firmer pegs. Well, floating has lots of advantages, but it means giving up the nominal anchor. So the question arises, if the exchange rate is not going to be the nominal anchor, what is? Well, inflation targeting, I think, was in the right place at the right time. Originally developed in around 1990 by New Zealand, Canada, Sweden, UK, 5 advanced countries initially, and then popularity really caught on, adopted by many emerging market countries after 1999. Colombia, Mexico, Brazil, Chile, and others, and still probably maybe the most popular. When the IMF comes around and asks, "What's your nominal anchor?" Lots of countries say inflation targeting these days rather than exchange rate targeting or money targeting. There's studies, many of which suggest that inflation targeting was successful. Here's one. Here's the mean reduction in the inflation rate, the fall in the inflation rate among the countries that adopted inflation targeting before and after. And here's the control group, the ones that did not adopt inflation targeting. And sure enough, their inflation came down as well. But the fall in inflation was almost double among the inflation targeters. Now, as so often, I'm not sure about the identification. It could be that those were countries that, for other reasons, had to or felt they had to take severe measures to reduce inflation. And you're not sure that the inflation targeting alone did it. But by and large, I think there has been a feeling that inflation targeting has functioned pretty well. One example that's given by some of the literature is Brazil, which had two severe challenges, exiting the Real plan in early 1999, and then 2002, when Lula, who of course as of then had a history of being hostile to IMF programs and being sounding like he was soft on inflation. When he pulled ahead in the polls, there was a lot of speculation, a lot of money moving out of the Real. And of course, it turned out he didn't do those things, but people didn't know them at the time. And anyway, some of these papers credit inflation targeting with providing a firm anchor for expectations and helping Brazil make it through this period. There's a paper by Fraga, Goldfein, and Manella that has an interesting finding that maybe I read more significance in it than the authors do. I'm not sure, but the finding is that among emerging markets, those that target inflation tend to miss their declared targets. Let me say that the other way around. Among inflation targeting central banks, those in emerging markets tend to miss their declared targets by far more than advanced country central banks do. I mean, they all sometimes miss their targets, but it's a stronger difference, a stronger tendency among the inflation targeting central banks, which I think is an important finding because my view is if you're going to announce an intermediate target, and I'm not talking just about announcing a target, what your desired inflation rate is in the very long run, but if you're trying to provide some guidance over the next few years, the only reason why you would do that, it seems to me, is transparency, communication, credibility, to allow the public to kind of monitor that you're doing what you say you're doing. And if that's the point, I see no point in announcing a target if you then can't satisfy it, if you can't meet it in a very big systematic way. So, for example, the Bundesbank always used to insist that it was targeting money, always used to announce money targets, always used to miss its money targets. And somehow they thought that added to their credibility. I never quite understood that, but the Bundesbank had enough credibility that it could get away with that. I'm not sure that everyone else can get away with announcing targets that you just persistently miss by a big margin. And that suggests that you should choose a target that you think you can hit reasonably well most of the time. Lots of other studies of inflation targeting in emerging market countries. Here are some of them, and most of them tend to be pretty positive on it. I would argue that the global financial crisis, it started in 2008, put some strains on inflation targeting as a regime, analogously to the way that the currency crises in the late 90s put strains on the regime of exchange rate targeting. And if you want to go farther back, analogous to the way the early 80s put strains on money targeting. Here I've listed 3 kinds of nominal variables that central bankers realized they really had to look at. They might claim they were only interested in inflation. They might claim they were only looking at these other variables to the extent that it had implications for inflation. But I think the truth is that we learned after 2008 that in advanced countries and emerging market countries, we learned that you can't be completely indifferent to asset prices. If housing prices and equity prices are very high, it looks like a bubble, that's something you need to pay some attention to. Also, I would say commodity prices and the exchange rate. I mean, many countries that said they were indifferent to the exchange rate unless it had implications for inflation really weren't indifferent. This is the famous fear of floating that Carmen Reinhart coined the phrase in the Calvo and Reinhart papers, that countries really do care about their exchange rate above and beyond implications for the inflation rate. It seems to me that most of the theoretical and analysis of inflation targeting is better suited to big industrialized countries than to developing countries in a number of respects. The models usually do not feature exogenous shocks in trade conditions or difficulties in the external accounts. Maybe that's because they assume that if you have an adverse trade shock or whatever, you can finance it. The financial markets work well and can smooth consumption and investment in the case of shocks. But we know that international capital markets don't actually smooth external shocks. I mean, particularly for emerging market countries, that the capital flows are often more often pro-cyclical than counter-cyclical. So any model that doesn't allow for crises or concerns in the area of the external accounts, the balance of payments, I think is not going to be a model that is really suitable for most purposes for emerging market countries. Another one, a related one, is that inflation targeting can be vulnerable to supply shocks and trade shocks, and those are larger for developing countries, as I mentioned before. And so I'm going to say this a few times, but let me do the first pass. And let me be clear, when I say inflation targeting, I'm talking about a particular kind. I'm talking about, let's hypothetically say it's strict. And let's assume we're talking about setting a target for inflation for a year or two into the future, or a range. I know many people by inflation targeting mean flexible inflation targeting. They mean we've got a long-term goal for inflation, which in the advanced countries is typically 2%. And we announce what that goal is, but we're not making any commitments for the shorter term. So I've got nothing against that at all. In a sense, that's what the Fed policy is, and that's probably what it should be. But in many countries feel a need for some greater degree of communication, whether it's forward guidance or announcing some rough target, or even if it's only the Monetary Policy Committee or the equivalent of the Fed Open Market Committee having projections for what the path of inflation is, or whatever, over the next few years. But people look at that. Certainly, the markets look at that. And I have a problem with the prevalence of, I would say, the universality for that. I mean, true, sometimes it's core CPI, but that doesn't fully get at my problem. What's my problem? CPI doesn't. It's not robust with respect to terms of trade shocks. It doesn't allow monetary policy to respond in the way that it should when the shock is a terms of trade shock or a supply shock, either one. So, for example, I have here under
you look at some indicators,
targeting.
Say again, this cannot be
supply shock. It could be increase in oil prices if you're
something more
fundamental. It could be an adverse productivity
you mentioned,
shock,
for example,
or
high levels of
disaster,
reserves,
whatever.
being important to weather the storm.
If you're going to pay any attention to the CPI targeting, that says that to prevent it
there
from
might be
rising,
some other factors
in the face of this adverse supply shock, monetary policy has to tighten.
For being able to accumulate high levels of reserves.
The calibration, the dimension on which I mean tighten, is it has to tighten enough that all of the fall in nominal GDP is borne by real GDP, which isn't what you want, I would argue. Most objective functions would say that monetary authorities should allow part of the shock to show up as a rise in the price level rather than having all of it show up as a fall in output. Now, if you think that'll damage your, long-run inflation-fighting credibility and your inflation anchor and all that, that's an issue. But the way the issue goes is if ahead of time, ex ante, you announced some nominal anchor, you want it to be a nominal anchor you can live with. And I would say that the CPI is not a nominal anchor that you can live with when there is a supply shock or a terms of trade shock. I'll come back to that and elaborate on that shortly. Let me see one of these. I see a question. Let me go on. Exchange rate regimes, huge topic. In the survey, I talk about the advantages of fixed exchange rates, of which there are many, advantages of floating exchange rates, of which there are many, and then the criteria that are used to make that choice, and all the research that's been done both theoretically and empirically on this. Among the advantages of fixed exchange rates, for present purposes, let me highlight the credibility of a nominal anchor. And it is, of course, something that's directly measurable. You can hit it exactly. I mean, there are speculative attacks, and central banks sometimes have to give up attempts to defend the currency. But there's really, no doubt whether you're meeting a target or not if it's a truly fixed exchange rate. Whereas with M1 and the CPI and nominal GDP, there are more issues of measurement problems, and can you hit it even if you want to, and so on. So one of the advantages of fixed exchange rates is it does provide a nominal anchor. I also have actually 5 advantages of fixed rates, 5 advantages of floating rates. The advantage of floating rates that I want to emphasize here is accommodating terms of trade shocks. Classic textbook argument, advantage of a floating exchange rate is you can accommodate terms of trade shocks. If you fix the exchange rate, you get pro-cyclical monetary policy in the face of a terms of trade shock. Here I've got this picture of a guy who's chained down by the dollar. So if you're a commodity exporter, you have a commodity boom, money flows in, can have excessive credit creation, can lead to excessive demand and inflation. I guess these days we also say asset bubbles. And an example would be some oil exporters during the oil boom in the last decade. Persian Gulf countries, for example, experienced inflation and overheating, and because they had a rigid link to the dollar, I would argue. And then when the money flows back out during the commodity bust, which is where we are now over the last year, if you're an oil producer,
yes, Oscar, go ahead.
Or many other commodities, then you have the symmetric problem. You have a credit excess supply, recession, balance of payments crisis.
I want to talk about your concept of graduation.
Some of the countries that had an exchange rate target and
from
oil producing countries that had exchange rate targets, and then over the last year have had pretty severe problems. I would say, worse problems. If you're an oil producer and the price of oil falls by 50%, you have a problem no matter what. But I would say countries like Kazakhstan, Azerbaijan, Nigeria, others have the worst problems because of insufficiently flexible exchange
graduating from
the same thing
kind of
happened
procyclicality,
in the
the one that you
late
just showing.
90s, I would say. Fall in export prices played some role in those crises as well. Floating accommodates terms of trade shocks. I've got this floating bottle as my symbol of floating. If exchange rate is floating, the terms of trade, when the terms of trade improve, the currency automatically appreciates, which helps you prevent excess money flows and overheating and inflation. If the terms of trade worsen, the currency automatically depreciates, preventing recession and
crisis in the external sector.
Crises. So they've been called commodity currencies. Countries like Australia have had a lot of success for quite a while. And I would say in more recent years, countries like Chile, where the exchange rate automatically accommodates the terms of trade changes. Now, of course, there are disadvantages of floating, even just with respect to the terms of trade shocks. Sometimes the swing in the exchange rate can be excessive. And you need some nominal anchor. So main point I want to make during the remainder of my time is the desirability of combining nominal anchor, which a fixed exchange rate gives you, robustness or accommodation of terms of trade shocks, which a floating exchange rate gives you. Do we have to choose between those two things, or can we have a combination of both? So returning to this issue of demand versus supply shocks, there is this old wisdom that fixed exchange rates work best if shocks are mostly internal demand shocks, for example, in the monetary sector, and floating rates work best if shocks tend to be real shocks, such as external terms of trade shocks. One set of supply shocks, as I mentioned, that is exogenous, you can use and it's an instrumental variable, or natural disasters. There's a paper by Ram Charan that finds that with respect to those shocks, countries that are floating have a more stable economies. A common source of real shocks are the trade shocks. So let's talk about that. Terms of trade variability has been high, as we mentioned. It's when commodity prices go up, oil prices and others, that's a favorable terms of trade shock for some and unfavorable terms of trade shock for others. But either way, the textbook theory says that you do better if you float. And I'm going to cite four relatively recent empirical studies that support the idea that for a country that is exposed to terms of trade volatility, especially commodity exporters, that you do better with a floating exchange rate. Broda, Edwards, and Liviati, Rafik, and Cespedes and Velasco. And I'll show you just a sample result from Cespedes and Velasco, relatively recent paper. They look at big commodity price swings for commodity producing countries, and when there's a swing upward and then reverse downward, there does tend to be a loss in output, and the bigger the change in the commodity price, the bigger the loss in output. But they also find statistically significant exchange rate flexibility. For the countries that have more flexible exchange rates, they suffer less of a downturn when the commodity price goes back down. 107 episodes of major commodity boom-bust cycles. So my last major category here, if we have time, I'll talk about vulnerability to financial crises and to risk on, risk off, and increase in Fed interest rates and all that. But the last of the topics that I wanted to be sure to get through is procyclicality. And there's different kinds of procyclicality. Procyclicality of capital flows, which in theory are supposed to be countercyclical. Procyclicality of fiscal policy, which also in theory, the theory of good governance, should be countercyclical, if anything. And pro-cyclicality of monetary policy, which I've already mentioned, that if the exchange rate is not allowed to accommodate trade shocks, then you can get a pro-cyclical credit creation.
If not, we really,
which is the case under exchange rate targeting, but I would also argue under the CPI targeting.
Being so generous with your time and giving us such a broad
so let me elaborate on those. First, the pro-cyclicality of emerging market capital flows. It's still the case that most of our theories are built around intertemporal optimization. Countries should borrow during temporary downturns and repay during the upturns. In practice, capital flows are more pro-cyclical
for you to review, and you can let me know.
Many studies of this, but here's
if I can upload it to the webpage,
5 studies econometrically
see it anytime they want.
Capital flows. Related perhaps to the Lucas paradox, lots of studies of that. At least they're kind of analogous failures.
Thank you very much, and thank you everyone for joining us. Next week we'll have a seminar because we have a course with
we've got a lot of theories, adjustments of the theory to explain this, and they mostly have to do with imperfections in the capital markets,
Stephanie
such as asymmetric information, default risk, and the need to have collateral.
June 16.
And of course, if you're booming,
you've got a
commodity boom, and you've got the collateral, so everyone wants to lend to you because